Hey guys, this is John Watts. Welcome to our video. What we're going to talk about in this video is a recent law that was designed to help homeowners who have had some debt forgiveness. So some of their mortgage has been forgiven either in a loan modification or maybe a short sale. And that can be a taxable event. In other words, what's been forgiven can actually be considered income to you. And so Congress passed a law that said we're not going to do that under some circumstances. But then that law expired. Well, it was recently revived or brought back. And there's a great article here by NCLC, and the website's nclc.org. I'll have the actual link that we have up here. I'll have that in the description of this video. But if you're not familiar with NCLC, they are most famous for having just a fantastic set of books on any type of consumer law issue, dealing with debt collectors, dealing with foreclosures, dealing with student loans, dealing with credit reporting. Just wonderful. And this is an article that is definitely worth your time if you are in this situation. Maybe you have in the recent past had some of your mortgage debt forgiven, or maybe you're facing this in the future. This will be very good information. And this is not the end all be all, but this is a very good starting place for you to then go research this and get with whoever does your taxes to see if you can take advantage of this good law. So what we're talking about here is the qualified principal residence indebtedness. And we're talking about excluding this or excluding some debt forgiveness. And this was a law that had kind of died, or sometimes it's called sunsetting. It had gone away, but that's now been revived and extended. So let's see what we've got here. So we've got this qualified principal residence indebtedness exclusion. This actually expired in 2017, but now it's going to go through January 1 of 2021. So it may be extended again, but there's no guarantee of that. And the interesting thing about this is it's going to apply retroactively to 2018 and 2019. So remember, the exclusion ended in 2017. So if you had some debt forgiveness on your mortgage in 2018 or 2019, you're kind of out of luck, but now it's okay. So let's talk about what this does. So let me highlight this sentence for us here. So when the principal amount of a homeowner's mortgage debt is partially or fully forgiven through a short sale, loan modification, or however else it might be described, the amount forgiven is often included in your gross income. And that can be a pretty strong tax liability. So here's the theory. I'll give you the theory, then give you an example first. So the theory is, take it outside the home context. You loan me $10,000. Well, as soon as you loan me that money, I literally have $10,000 in cash. Do I pay any taxes on that? No, because it's a loan. And the IRS is expecting me to pay back that loan with after-tax dollars. So in other words, I get my paycheck or however I get paid, and taxes are taken out, and then I use that money, and maybe I'm paying back $1,000 a month or whatever it is. So I'm paying you back with after-tax dollars. But what if I never pay you back? Well, then the IRS says, well, wait a minute, that's not quite fair, because they say, John, you got that $10,000 and never paid taxes on it, and you never paid it back. So we're going to consider that $10,000 to be income to you, just as if I had gotten a $10,000 bonus at work. I'm going to now pay taxes on it. So it's sort of a double whammy. You know, you've got this debt, and in a mortgage context, maybe you lose your house and then some of that debt's forgiven. And so you're already going through a tough time. I mean, it's good to have it forgiven, but then you get hit with taxes. So what does this law allow us to do? Well, it can allow us to exclude up to $2 million of the forgiven debt related to a decline in value of the residence or financial condition of the taxpayer. And then let's see here sort of how this will work in practical terms. So late January, early February 2020, so right now, homeowner whose mortgage principal was forgiven in part or in full in 2019, you may get a 1099 form that's also sent to the IRS. 1099 form is just saying you have X number of dollars of income. It could be because you're an independent contractor, or it could be because debt has been forgiven. So this form includes what the lender claims is the amount of the forgiven debt should only include the principal that's forgiven, not interest and not reduced monthly payments. I will say this, and the author of this paper is a law school professor on taxes. I have seen different viewpoints on this. Some people say it can include interest that has piled up and then is forgiven. But the point is, at least there's a good argument that it should only be the principal that is forgiven. Go back to my example. You loan me $10,000. I don't pay you back $10,000. Well, that's what the income should be, not, well, I also owe you $5,000 in interest that I didn't pay you. I may owe you that, but that shouldn't be considered taxable income. But just keep in mind that is sort of a point of controversy. And if this exclusion applies, then you don't have to report that forgiven principal as taxable income. So, a couple things. It's only your main home. So we're not talking about a vacation home, a condo at the beach, but it's not your main house. We're not talking about rental houses, investment property. And there's a couple other ways that things can be forgiven. One would be bankruptcy. Well, if the debt is forgiven or canceled as part of a bankruptcy filing, then use that exclusion. You don't have to use this exclusion that we're talking about here. Instead, just use the bankruptcy exclusion because that is not considered taxable. And then it also points out that taxpayer can opt to exclude the canceled debt from income under the insolvency exclusion, but only if you were insolvent immediately before and after cancellation of debt. So typically, insolvency means, in this context, that your liabilities, the money that you owe, is greater than your assets or your net worth. And you got to get with the tax person on this to, make sure that you truly fit within this exclusion. So if you have that, that's wonderful. If it was discharge in bankruptcy, that's wonderful. But there's a whole lot of people that they're not insolvent, they don't meet that test, and the debt was not discharged in bankruptcy. Instead, they had $100,000, $50,000, $250,000, whatever it is, forgiven. And I mean, think about that. If you have, let's just use simple numbers, $300,000 is forgiven. So you had a very expensive house, $300,000 is forgiven. And to make it simple, you're in a 33% tax bracket. Well, you would owe $100,000 in actual taxes, like you got to write a check for $100,000. So that's how important this law is. So here's a few more details on it. So it applies to debt discharged before January 1 of next year, 2021, and is retroactive to forgiven debt since the beginning of 2018. Now, up until 2018, we already were protected under this law, but remember the law it expired, okay? And so that's why they're having to sort of word it this way. So here's an example. A homeowner whose 2018 tax return included forgiven mortgage loan principal as taxable income can file an amended return. So you go to your tax person and say, look, can I take advantage of this new law? Look at my 2018 return and let's see if we can amend it, because you might be entitled to a refund or you might reduce additional taxes that you owe. And so that's what this is saying here. Amended return to exclude the income, obtain a refund or reduce taxes still owed. Amended tax returns from 2018 should be filed as soon as possible, but not later than April 15, 2022. And then this says it'll apply to a written agreement entered into before January 1, 2021, even if the discharge takes place later. So you might enter into an agreement, right now it's February 15, 2020. What if you enter into an agreement on December 30, 2020? Well, the quote discharge might actually take place in middle of January 2021 or February 2021. This law should still work. Now again, you got to get with a professional on this to make sure about it. And the author points out, it's a very good point, this change in law should be considered in evaluating any future loan modification of the mortgage loan on a homeowner's principal residence. So here's some instructions from the IRS. So how do we do this? And so let me get this highlighted here. So to take advantage of this, because you fit within this, you attach Form 982 to your federal income tax return and check the box on line 1E. And then it goes on to say on line 2, you include the amount of the canceled principal on your residence. And if you continue to own your home after the cancellation, the basis must be reduced. Okay, so again, not to get too deep in the tax stuff, but let's say you buy your house at $300,000 and then you sell it for $400,000. Well, how much sort of profit did you make? Well, from a tax standpoint, we would say your basis, what you bought it for, is $300,000. So if you sell it for $400,000, there's $100,000 gain. And what the author is saying here is if you had some debt forgiveness and you're able to exclude that from your income, but you still own your house, the IRS is going to reduce your basis in the house. So in other words, if you're able to exclude $100,000 in income, they're going to say, well, you need to lower the basis in your house $100,000, which just means next time you sell your house, you're going to have more gains. Now, typically, when we're selling our principal residence, we'll go buy another house, or there can be some other exclusion, which is beyond the scope of this article or this video. But just understand, this can get a little bit complicated. So again, definitely get some professional help. And if taxpayer opts for the insolvency exclusion, you use line 1B instead of line 1E. And so anyway, there's a few more things in here that you can read. And this is an important thing. I do want to highlight this literally and figuratively as we go through. Unless an attorney advising a client considers her or himself competent to act as a tax advisor, the attorney should instruct any client where there are tax implications to obtain the advice of a competent tax attorney or tax accountant. And I think that that's absolutely true. We can know kind of in general how this stuff works, but it makes the most sense to go sit down with your CPA or somebody that can say, yes, I will tell you absolutely whether or not you qualify for this. So hope that that's helpful. This is a little description of the author here. And again, I'll have this link that's up here will be in the description of this video. And if you are thinking about a loan modification, or maybe you've been offered some debt forgiveness on your mortgage, it certainly is important to understand how that will impact you from a tax standpoint. So again, hope it's helpful, and I appreciate you guys watching this, and I will catch you in the next video. Okay, bye-bye.